The man who famously predicted the 2008 financial crisis is sounding the alarm again, but this time it's not about bad mortgages. You might remember the movie The Big Short. Steve Carell's character was based on a real-life investor named Steve Eisman, the guy who saw the whole system was rotten when no one else would listen. Well, fast forward today and Eisman has a new warning for 2025. He says the AI boom that has everyone so excited is actually a smokescreen hiding an economy that's on the verge of collapse. He's pointed out that without the massive spending on AI, our GDP growth is nearly flat. He calls it a tale of two economies. A nation where the dazzling fortunes of a few tech giants are masking the quiet desperation of everyone else. And he's not only one. Other economists are pointing out the same data, warning that the US might be on the brink of a known AI recession. What does that mean? Well, it means if you strip out the frantic gold rush level spending on AI, the rest of the American economy is grinding to a halt. So what does this mean for your job, your savings, your future? Well, it means the stability you might be feeling could be an illusion. The risks are real and very few people are talking about them. I'm going to break down Steve Eisman's warning, look at the cracks already appearing in the economy's foundation, and most importantly talk about what you can do to prepare. I mean, this isn't just about stocks, it's about understanding the hidden forces shaping your financial life. To really get what Eisman is pointing at, you have to look past the headlines. On the surface, things look okay. The stock market is hitting new highs, politicians are making victory laps, but Steve Eisman, a man who built his career on seeing through the official story, says these numbers are dangerously misleading. His main point is brutally simple. The American economy has split in two. There's the AI economy and then there's the everything else. The AI economy is on fire. Companies like Meta, Google and Amazon are spending a combined total of over $300 billion on AI related projects. Some analysts predict that global spending on data centers will skyrocket in the coming years, nearly doubling what it was just a few years prior. This isn't just investments, it's a feeding frenzy, and it's single-handedly propping up our national growth numbers. Now, for the scary part, economists digging into the numbers are finding that if you pull this AI spending out of the equation, the picture gets ugly. One analysis from Pantheon Macroeconomics estimated that without AI-related spending, GDP growth in the first half of 2025 would have been a measly 0.6%, much lower than the reported 1.1%. Steve Eisman goes even further, suggesting that without these AI capital expenditures, the rest of the economy is growing at less than 0.5%. Some analysis put it even lower, suggesting that if you exclude investments in information processing equipment, the US economy grew at only 0.1% annual rate in the first half of 2025. I mean, let that sink in. One of the world's largest economies is basically flatlining once you remove the influence of one single hyperinflated sector. It's like a car that looks like it's speeding down the highway, but it's actually being carried on the back of a tow truck. The wheels are spinning, but the engine is dead. And this is the smokescreen Eisman draws a powerful parallel to the dot-com bubble of the late 90s. Back then, everyone was convinced the internet would change the world, and they were right eventually, but in the short term, a gold rush of overinvestments in half-baked ideas led directly to the 2001 recession. Eisman sees the echoes of today. Everyone is chasing AI, convinced it's the future, and it might be. But what's the return on that investment, and when will it actually show up? The spending is happening now, creating an artificial boost, but the real profits and productivity gains could be years, maybe even decades away. If those returns take too long or disappoint, that fire hose of investments will slow to a trickle, and what Eisman calls the painful digestion period will begin. The tow truck will stop and the car with no engine will come to a dead halt. We're celebrating the speed of a tow truck, ignoring that our own engine has stalled. So if the AI boom is the only thing keeping us afloat, what does the rest of the economy actually look like? Why is it so weak? Well, this is where we see the cracks that the AI smokescreen is hiding, and it's not a pretty picture. It's a story of a struggling consumer, indebted companies, and a Federal Reserve that's running out of moves. Let's start with the traditional engine of the American economy, you the consumer, but that engine is sputtering. While the top 20% are doing just fine, the rest of the economy is getting squeezed. The real retail sales, adjusted for inflation, have been basically flat for over 4 years. People aren't buying more stuff, they're just trying to keep their heads above water. And how are they doing it? Well, debt. Total US household debt soared to over $18 trillion in 2025. Credit card balances alone now sits at a breathtaking $1.21 trillion, and people aren't just borrowing more, they're struggling to pay it back. Delinquencies rates, the percentage of people late to their payments, are rising for credit cards, auto loans, and pretty much everything else. The personal saving rate tells the same story. In August 2025, it was just 4.6%, way below the long-term average of 8.42%. People have less cushion and more debt, all while paying more for the basics. That is not a healthy consumer. That's a consumer under immense pressure. But now, let's look at the corporate world. It's another tale of two cities. On one side, you have the Magnificent Seven and other tech giants. Their stocks are pumped up by the AI story. They have endless cash to fund the infrastructure boom, but what about everyone else? Well, Torsten Slok, the chief economist at Apollo Global Management, put it bluntly. There is basically no growth in corporate capex outside of the AI at the moment. Think about that. The business that make up the real economy, manufacturing, retail, service, they aren't investing or expanding. While some non-tech sectors beat expectations in the first half of 2025, their growth is a joke compared to the AI, and many are warning of a tough road ahead. We're seeing a massive split. One economist, Jason Furman, found that a category including information processing equipment and the software was responsible for a staggering 92% of GDP growth in the first half of 2025. This isn't a broad recovery, it's a party for a tiny slice of the economy. While the rest is left out in the cold, it's a fragile system, a house of cards resting on a single ace of AI. If the card wobbles, the whole thing will come down crashing. And this brings us to the third crack, the Federal Reserve. Normally, if the economy slows down, the Fed cuts interest rates to get things moving again, but this isn't a normal cycle. Eisman himself has been skeptical about the Fed's ability to cut rates aggressively, predicting earlier this year he only expected one cut, far less than what the market was hoping for. The reason is inflation. Even after the Fed started cutting rates in September 2025, they're in a bind. Inflation is still stubbornly above their 2% target. Cut rates too much and they risk inflation roaring back to life. So while the market is hoping for more cuts, these aren't the deep recession-fighting cuts we saw after 2008. Eisman believes the Fed will likely only cut by about 100 basis points, just 1% in this entire cycle. He calls it tinkering. It might help the housing market a little, but it's no silver bullet. So here's the terrifying summary. We have a consumer who is tapped out and buried in debt. We have a corporate world where outside of a few tech darlings there is virtually no growth, and we have a Federal Reserve with its hands tied. All of this is being hidden by the blindly bright light of the AI boom. The question is, what happens when that light flickers? Well, according to Eisman, the non-AI recession becomes just a recession, and everyone who was staring at the bright light will be left in the dark. But look, if this breakdown is making sense and you want to stay ahead of the major economic shifts the media usually misses, do me a favor and hit the subscribe button and turn on notification. I'm dedicated to digging into what experts are really saying so you can make smarter moves with your money. With this daunting picture, the immediate question is, what are we supposed to do? Well, it's easy to feel powerless, but the goal here isn't to be scared, as I've said in previous videos. It's to prepare you. Knowledge is your first line of defense. Now, let me be clear, this is not financial advice. This is about exploring strategies and mindsets based on the principles that investors like Eisman use when they see the storm coming. The key is to shift your perspective from chasing the hype to building resilience. First, let's rethink diversification. It's a word that gets thrown around a lot, but it has a new meaning here. It's not just about owning different stocks, it's about diversifying away from the central point of failure. Right now, the market gains are incredibly concentrated. Some estimates suggest that AI-related stocks have accounted for as much as 60 to 75% of the S&P 500 gains. If your portfolio is just those same tech giants, you aren't diversified. You're making a concentrated bet on the AI hype train running forever. Eisman has talked about the thesis he calls the revenge of the old school. This means looking at traditional boring industries that are essential to the real economy. He's mentioned sectors like construction, utilities, and industrial and materials that could benefit from government spending. Things completely separate from the AI hype. These are the companies that build the physical world, not just the digital one. The logic is simple. Find value where no one else is looking. Second is to focus on quality and fundamentals. When the tide goes out, you see who's been swimming naked. In a bubble, any company that whispers AI in press releases sees its stock soars. When a correction comes, the only thing that matters is a real profit and a strong balance sheet. This means doing your homework. Eisman has noted he's scrutinizing reports from consumer-facing companies because that's where the weakness is showing up. Look past the headline numbers. Are profit margins stable? Are they drowning in debt? Eisman himself says that for the AI boom to be justified, companies must generate very strong returns on investments. If you can't see a clear path to that return for a company you own, you need to ask yourself why. Third is to get your mindset right and prepare for volatility. It's incredibly hard to resist the fear of missing out FOMO when it feels like everything is getting rich of AI stocks. It's tempting to go all in, but as Eisman has pointed out, timing the market is a fool's game. For long-term investors, the smartest move is to stay invested, but be invested smartly. This could mean rebalancing if the AI boom has made it take a huge part of your portfolio. Consider trimming these positions and reallocating profits to those boring sectors we just talked about. You're not trying to time a crash, you're managing risk. risk. You're taking some chips off the table after a hot streak and putting them somewhere with better odds. Having some cash ready isn't a bad idea either, not to time the bottom but to have firepower when a good companies go on sale. And finally, expand your information diet. The mainstream financial media loves a good narrative, and right now the narrative is AI changes everything. To get a clear picture, you have to seek out contrarian voices, follow economists who focus on broad data, not just stock prices, and read the bear cases as well as the bull cases. That's how you make informed decisions instead of just getting carried along by the herd. We're at a precarious moment. The story of an AI-powered ever-rising market is compelling, but as Steve Eisman warns, it might be a dangerous fiction. We have an economy held up by the spending of a few tech giants, while the real economy shows a serious signs of weakness, a consumer buried in debt and a corporate sector starved for investment outside of AI, and a Federal Reserve with limited options. It's a combustible mix. The warning from the man who saw the 2008 crisis coming isn't a prophecy of doom, but a call for prudence. It's a reminder that fundamentals always win in the end. The solution isn't to panic, but to prepare. Build a resilient portfolio, focus on quality, and don't get swept up in the hype. The coming months will be telling. Will the AI boom lift the entire economy, or will it prove to be another bubble? No one knows for sure, but ignoring the cracks in the foundation is a risk you can't afford to take. What do you think? Is Eisman right? Is the AI boom hiding a deeper problem, or is this time truly different? Let me know your thoughts in the comments below, and if you want to keep diving into the trends that will define our financial future, make sure you subscribe and click the bell. I've got more videos coming up, and I hope I'll see you guys in next videos.